Hey guys, in this video we're going to go ahead and talk about bad debt expense, specifically keeping in mind that, remember, bad debt expense is just a cost of doing business, and it's what we record when we know that all of those customers who paid us on account, not all of them are really going to pay us back. And we're going to be really diving deeper into what this means and how bad debt expense can really be calculated. So keeping that in mind, let's go ahead and jump in. So we really have kind of two different ways to account for bad debt expense. The first is with the specific write-off method, or the direct write-off method, as it's called. That won't really be our focus. The focus for this accounting class will be the allowance method, which is also the method that GAAP follows. So the specific direct write-off method is going to be that you're debiting bad debt expense and crediting your accounts receivable and writing those accounts off only once you know that that specific account will go bad and that customer won't pay you back. Whereas with the allowance method, you are creating an allowance when you debit your bad debt expense, and each period you're making just an estimate of saying, hey, in this period, I think I am going to have this much amount of customers who aren't going to be paying me back, and so I will create this AFDA account, which is a contra asset account. And then in the future, when I actually specifically identify which accounts I'm not going to be receiving payment from, only then am I going to decrease that contra account and credit my accounts receivable. So with this allowance method, we have this account called AFDA here, which just means allowance for doubtful accounts. It's an allowance count, and it is a contra asset. And the great thing about this allowance method is that it actually conforms to the matching principle of accounting. And what that means is in those periods in which you're recognizing revenue, you're better matching the expense related to those revenues, which is great. And so this conforms to GAAP. Whereas if you're looking at the specific write-off method, that is not GAAP. And it's not GAAP because under this method, the expense that you're recording might actually be occurring in a period after that initial sale was recorded, which violates that matching principle. So let's go ahead and continue this discussion of the allowance method, since that's going to be the focus for this class. So moving forward, the allowance method has you calculate for your bad debt expense in kind of two distinct ways. So the first method is going to be called the percentage of credit sales, where you are estimating your bad debt expense based on the percentage of credit sales. And the second method is this aging of your accounts receivable, where you're actually estimating the balance in your allowance for doubtful accounts and then using that to solve for your bad debt expense. So slightly different. But first we'll discuss this percentage of credit sales method with an example. And in this example, we have Koshiro's Cupcake Company that has $100,000 in total sales, with 80% of those sales being on credit. And historically, the company estimates that about 3% of those sales on credit are going to be uncollectible. And when we're solving for bad debt expense using the percentage of credit sales method, you'll first take total sales here and multiply that by the percent that were on credit, and then multiply that by the historical percentage uncollectible to get a bad debt expense of $2,400. I think it's really important to note, if they just automatically give you credit sales, you can just use that number. But in this case, since they gave us total sales and then the percentage that were on credit, that's why we were taking that $100,000 and multiplying it by 80%. If they had told us that $80,000 of credit sales were made, we could just directly pull that $80,000 and then multiply it by the 3%. And hopefully you can see why we're only considering sales on credit, because if sales occurred with cash, then we have already received that cash. There's no chance of it not being collected. Okay, great. So now we're going to go ahead and look at an example of this aging of your accounts receivable method instead. So in this example, we're going to be looking at Barron's Bakery and the information given to us below about the ages of their accounts and their account receivable. And just while I'm kind of recording all of this information, it's important to note that when you're doing an aging of accounts receivable method, You are calculating specifically the ending balance in your allowance for doubtful accounts account, because what you're doing here is you are breaking apart the total amount of your accounts receivable into different age groups and saying, well, if I have this amount in my accounts receivable that is between, let's say, 1 to 30 days old, then I think my odds of collection are going to be pretty good. Versus if I have an account in my accounts receivable that has been there for over 60 days, let's say it's been in there for 2 years, my percent that that's going to be uncollectible is going to be significantly higher than it is for an account that has only been in my accounts receivable for a couple days or under a month. And usually in these types of questions, you see them set up fairly similarly. And using this information, you can create this new column that I'm making here on the right, which is an estimated amount uncollectible. So you take that amount in each age group and you multiply it by the percentage that you deem it to be uncollectible. So for example, my 1 to 30 days, I multiplied the 150,000 times 1%. Now I'm multiplying the 30,000 times 5% and the 20,000 times 20% to get the estimated amount uncollectible in each age group. And then I'm just summing them to get my total here of 7,000. And I really want to emphasize this fact that the $7,000 that I just calculated, this is not bad debt expense. I repeat, the $7,000 is not my bad debt expense for the period. Instead, it's my ending balance and my allowance for doubtful accounts account. That's the big distinction between this method and the one we just saw with the percentage of credit sales. So I'm just going to go ahead and summarize for you what this T account looks like. Again, it is a contra asset account. It will have a beginning balance, and then the item that makes your allowance for doubtful accounts bigger is your bad debt expense for the period. And then you'll have an ending balance, and then write-offs will also decrease this allowance for doubtful accounts, which we'll talk about in a later video. For both of my examples, we assumed write-offs were 0. And so looking at this ending balance in our AFDA account, we have to ask ourselves, well, what does it really mean? So remind yourself that the AFDA account is a contra account to our accounts receivable, which means that it's going to reduce our AR. And the whole purpose of it reducing our AR is to show the net realizable value, which is essentially the amount that we're actually expecting to receive from our accounts receivable. So when we do an aging of our accounts receivable, we're looking at the total accounts receivable, breaking those into age groups, and then estimating what percentage of those are going to be uncollectible. And since we're basing that total amount uncollectible based off the total amount in our accounts receivable, that will give us our ending balance in our AFDA account. If we were meant to find the bad debt expense for the period, we would have to use information related to the beginning balance and any write-offs to actually calculate that bad debt expense if we had only calculated our ending balance based on that aging of our accounts receivable. Comparing that to the percentage of credit sales method, where you're just directly estimating your bad debt expense, you can see why the aging of accounts receivable is a little bit more nuanced. Right now, what I'm going to do is I'm just going to kind of summarize the two examples that we went over. First, looking at Barron's example, that again was using that aging of our accounts receivable, and then we'll look at Koshiro's. But with Barron's example, let's just assume we had a beginning balance of $1,000. We calculated that our ending balance was going to equal $7,000, and assuming write-offs equaled 0, what we do is to calculate what our bad debt expense is, we would take the difference of that $7,000 and $1,000 to get a bad debt expense of $6,000. If we were going to go ahead and compare this to Koshiro's cupcake example, where Koshiro was again using that percentage of credit sales method, here we can estimate our bad debt expense directly, right? So even if in this AFDA account, if we had a beginning balance of for Koshiro's example, let's say $5,000. Even if we had a beginning balance, that doesn't really impact the amount of bad debt expense we estimate, because our bad debt expense is just a direct estimation of that percentage of credit sales that we calculated to be $2,400. So again, with the percentage of credit sales, as we saw in Koshiro's example, you directly calculate bad debt expense, whereas when you're using an aging of your accounts receivable, as in Baron's example, you solve for the ending balance in AFDA and then have to use your beginning balance and any write-offs to solve for your bad debt expense indirectly. So hopefully you found this helpful and keep it in mind when solving uncollectible account questions.